The financial industry has international diversification completely wrong. The information that is shared out there with investors like you and me in regards to diversifying internationally, to having international exposure, in my opinion, is completely wrong. I am going to share with you today real-world data from my personal dividend stock portfolio. I own 41 dividend-paying stocks. I was up really late last night crunching the numbers. I'm going to share data from my analysis that's right here behind this cool UK backdrop. You are going to see why the financial industry is completely wrong about international diversification. So let's get started. All right, everyone, so I have the UK shirt. I've got the UK backdrop because I'm representing one of my favorite cities out there, London, one of my favorite global cities. I'm going to remove this now. Check this out. This is why the financial industry is completely wrong about international diversification. I own 41 dividend-paying stocks. Most of the stocks that I own are based here in the United States, where I live. However, when I look at the revenue that comes in to the companies that I own, roughly 58% is coming from the US and the other 42% is coming internationally. Let me repeat that. When I just look at my companies, I'm a business owner. When I own shares of companies, I own those businesses. I own 41 businesses in my dividend-paying portfolio. When I just look at the revenue, the sales that are coming into those companies, many of them US-based, most of them US-based, only 58% of that revenue is actually coming from the US. The other 42% is coming internationally. Now, what the industry tells you and me is, hey, if you want international diversification, you need to go out there and buy a company that is based overseas. Or if you want international exposure, you need to go out there and buy an exchange-traded mutual fund, some kind of mutual fund, some kind of index fund that captures these international markets. And I am here to say that prevailing thought in the industry is just completely wrong. It is absolutely, completely wrong. In my experience, based on real-world data, I'm going to share how I calculated this data in a minute. Just owning United States companies, the right ones, it's possible to have huge international diversification like I do. Like I said, 58% of my revenue from the companies I own is coming from the US, but the other 42% international. And so how did I calculate all of this? What I did and why it took so long is I went last night through all of my 41 positions one by one. And what I did is I went to their investor relations websites and I pulled what's called the 10K. 10K is a code name for the annual report. A lot of these reports are several hundred pages long. Once I got into the annual reports, I went in and I tried to find how is the revenue broken up between the United States and international. In many cases, quite frankly, it was North America versus international. And so my number here, it's actually probably even more internationally diversified than it looks. Because when I say US here, this 58%, in some cases it was only US where I could pull out US, but in a lot of cases, it also included Canada. And so this 58%, if you look at Canada as international, like I do, that's another country, it's international revenue, my breakdown, my international exposure, it's even better than it looks here. What I did, however, is I went through these 10Ks, and being that they're several hundred pages long, sometimes it got really difficult to find the table somewhere in the appendix that broke down revenue by US or North America versus international. And so what I started doing is just a simple find, and I would do a find and I would look for these key terms. US, U period, S period, United States, North America. And so when I did a find and then I started clicking through all of the results from the find query, it made it a little bit quicker for me to find this information. And so the take home here is do the work. The prevailing thought out there is, hey, I own a United States company, United States-based company like Coca-Cola. Coca-Cola, oh, it's an icon of the United States. It's an icon, amazing beverage, brand name. Oh, they must do all of their sales in the United States. I think that's the prevailing thought in the industry. But what they don't tell you is if you go to the 10K, you go to Coca-Cola's 10K, this is one of my top 10 favorite stocks, it's number 9, you pull out the percentage that's coming international, it's actually 63%. Let me repeat that. 63% of the revenue at Coca-Cola Company is coming internationally. They are making more money. They are driving more sales internationally than they are in their home turf here in the United States. And so this is the key take home for everyone watching today is don't believe what seems to be apparent based on the industry out there. You do not necessarily have to buy international companies to diversify internationally. Now, I do own some international companies. I'll get to some of those in today's video. And obviously, they do have a lot of revenue internationally, but that's not the only way. As a U.S. investor or even as a global investor, if you're not based in the U.S. and you still want non-U.S. exposure, you can buy U.S. companies like Coca-Cola and get huge international exposure. And so that is the key takeaway, that the prevailing thought out there, it's just wrong. And the simple facts from the 10Ks prove it. And so this is how you do the work. There are no shortcuts in dividend investing. I buy and I hold stocks forever. I've been doing a lot of videos here on YouTube. Many of them are very long. And so some people sometimes ask me, Ian, why are videos so long? One of the reasons is there are no shortcuts here. And just like this took me a few hours to pull all of this data. And the data is not perfect. In certain cases, I'm going to release my updated stock portfolio pretty soon here this upcoming week. And I'm going to actually include all of the research I did here in that. And so if you're not already signed up for my stock portfolio, I'll include a link in the description below. But when you receive the stock portfolio, you'll actually see company by company what I pulled. And you'll also see some of the notes, some of the disclaimers. Because in certain cases, I had to get approximations, or I had to get as close as I could based on the data that I have. Thankfully, I would say in about 90% of the case, the 10Ks made it really easy to pull in international versus US or international versus North America. And so that was really cool. Now, one thing worth mentioning here as well is this is weighted. This is a weighted average. And so what I did is I weighted each position in my portfolio, the international versus US exposure. I weighted it based on that position size because some positions are much bigger. I have much more money in certain positions than others. For example, in my number 1 stock, Johnson & Johnson, I have a huge amount of money in that. So when I wanted to calculate my overall international versus US exposure, I gave J&J more weighting. I did a weighted average. So again, that's how I came up with my 58 versus 42. Now, I feel pretty good about that. I think 58% US, 42 international. I feel like I've got pretty good international exposure there. I like that. I'm very happy with that. And at a meta level, the reason I want international exposure is there is a lot of growth happening internationally. There's a lot just happening with demographics in the U.S., with an aging society and fewer, just in terms of GDP growth, there's going to be fewer younger people that are going to be of working age to really lift the GDP to the next level, unless there's this radical shift in per labor hour in terms of what it can return in terms of GDP. But there are other countries in the world where there's a completely different age distribution. There's a ton of young people. A lot of these are in emerging markets, and in those countries in general, economists believe that they're going to go through the roof. They are going to grow really quickly. One example is China. Another example is Africa. There are countries like these. India is another one, where there are expectations of phenomenal GDP growth, not because of many factors, but one of them being because of the age breakdown. And so because of the opportunity for added growth by having international exposure, obviously that's why I want it, but I still like the heavy US exposure because US is really, I would say, a very robust economy, very dynamic economy, and quite frankly, very stable. And I need something stable because I will live off of dividends. I'm already using a portion of my dividends to pay some of my bills. I'll link to a video about that in the description. But I need my dividends to be steady and growing. anyways, I've got that breakdown and I'm very happy with it. And so I want to go through a few things in terms of the specifics, the companies that I own. First and foremost, I want to go through my top 10. So what I have here are my top 10 favorite stocks of all time. And I want to show you what is the international exposure of each of these based on revenue. And I put boxes around some of them that were just really high, actually higher than I would have guessed. And so number one, Johnson & Johnson, 41% international. That alone, quite frankly, that metric gives an insight. It gives an insight to me. And what it tells me is I know the healthcare system here in the US is kind of broken. I know that at some point there's probably going to be some reforms. I think this is a risk factor for J&J is what I'm getting at. I love it. It's my number one favorite stock. I wish there was a little more international. I generally believe that the international revenue J&J is getting is probably a little bit more stable than the US. I could be wrong, but that's how I look at it. And so just having that insight, that metric gives me an insight. Pepsi, real similar to J&J, there's 38% coming international. So again, pretty heavy US focus, but that's all good. Now here's where things get interesting. McDonald's, my number 3 favorite stock. I love this company. I knew they had a pretty big international presence, but I didn't know it was this big. 64% of their revenue is coming internationally. They are getting more revenue internationally than they are getting here on their home turf in the United States. So just fantastic. United Technologies, this one shocked me. You think, hey, United Technologies, diversified industrial company, heavy in the aerospace sector. Boy, I would have thought that a lot of it, the lion's share would have been in the US, but no. More than half, 56% of their revenue is international. Moving on, Clorox. I knew this one would be low, only 17% international. I love this company, but that's something that's a risk factor with Clorox. They actually, in terms of the consumer packaged goods space, they're a bit smaller, so I guess that's okay. Room for growth. Duke. This is a regulated electric utility here in the United States, so 0% international. Realty income is kind of hard to pull, but more or less it's zero. They have some properties, it appears, in the UK, but more or less it's a US company. It's a real estate investment trust. They own all their properties here, therefore all the revenues coming domestically in the United States. So this one surprised me. I had no idea that Procter & Gamble had such a big international exposure. Like Coca-Cola, like McDonald's, like United Tech, more than half of their revenues coming internationally. It's coming at 56% international. So thrilled to see that. This is a stock, by the way, I was sharing on my channel back in 2018. I was going real heavy in 2018 when it was on sale. It's no longer on sale. It's now hitting all-time highs. This is why I buy stocks when they're trending down, stocks that I love, dividend stocks that I love, because if the fundamentals are there, I know sooner or later it's going to turn around. I don't want to buy Procter & Gamble now, but I'm sure happy I did in 2018, did really well on those buys, and I hope some of you at home did as well, took advantage of some of those opportunities in 2018. But anyways, 56%, just staggering international revenue. Coca-Cola, we talked about that at 63. Here's another one, 3M. I've been buying a lot of 3M in 2019, and I'm going to be buying a lot more. I'm probably, we'll see. I'm thinking about doubling my position here in the next few months, but we'll see. So 3M, 61% international. Who would have thought? I would not have guessed that. And so the takeaway just from these top 10 is I got surprised on some of these. I'm going to share with you some more surprises, but when you go home, you do the work. Do the work. That's takeaway number one. Don't just guesstimate. Don't just estimate. Don't listen to what the industry is telling you. Do the work. Go into the fine print. Do what I did. Spend the hours. Do the work. Figure out what the international exposure is. And then get ready for just some interesting surprises. And this nugget of information, it gives me a lot. It's only one data point, but it helps me make better decisions as an investor. And so, like I said, man, 3M, Coca-Cola, McDonald's, I had no idea their international exposure was that high. I love my top 10. When I add my next dollar as an investment, where am I going to place it? Well, as you guys know, you've been following me for a while, I love having international exposure. And so now knowing this data, knowing this fact of where the revenue is coming from, it helps me because it makes me feel better about putting money into 3M, Coca-Cola, McDonald's, because I want more international exposure. I value the international exposure. I like it. And so it's just one data point, but it helps me be a better investor and make better asset allocation decisions for my portfolio. So let's look at some surprises. Boy, this was another one. Air Products and Chemicals. I like this company, talk about it here sometimes, and I've done real well on it, not buying it here, except I am reinvesting dividends. But 62% international, that was a surprise. I didn't think they'd have that much international. I was really surprised by that. This one I put under surprises, but I wasn't surprised. I already knew this, but I think you're going to be surprised. You think about a company, this is why I'm doing this video, quite frankly. Colgate, ticker symbol CL. They make the toothpaste, among other things. Most people here in the US, they're thinking about investing. They think about investing in a company like Colgate, and they're like, oh, I'm just buying a US-based company who sells US-based products. I'm getting US-based investment exposure. This is where the industry is wrong. This is where we've been educated wrong, because when you go to Colgate's annual report, the 10K, international exposure, 78.5%. Most of this United States company's revenue is coming internationally. Huge, huge, vast percentage. And so most average investors out there, they don't know about this. And because they don't know about this, they're probably not making as informed investment decisions as they could. And I believe that the data, the knowledge is power in making informed investment decisions. And so this is actually why I got into Colgate. I wanted that added exposure internationally. I really value that in my Colgate position. So it wasn't really a surprise for me, but I bet it is for a lot of you watching at home. Unilever. This was not a surprise, but Unilever is an international company. It's an international company I own. A lot of people here on my channel tell me, Ian, you don't own any international companies. Well, yes, I do. One, 42% of my revenue is coming internationally, but two, I actually do own companies that are based overseas, such as Unilever. This one is 84% of their revenues coming internationally, the rest from the United States. So they do sell products here in the United States as well. But I do want to point that out, that yes, I do own companies that are based overseas, but quite frankly, it does not matter to me where the company's corporate office is. What matters to me more is this, the breakdown, US versus international revenue. So moving on, this one was a little bit surprising, Chevron. And I have some other oil stocks as well. They all kind of ended up like this. 69% international. And so the big shocker for me was all this big oil that I own. Big oil companies, juicy dividends, love these companies. They pay dividends that I can use to pay my bills. And one day I'll pay all the bills on the dividends. And I was just so surprised to see that most of the revenue for these companies, it's coming internationally. And so that was really cool. Now, be careful. Just because so this is where the industry is wrong again. And this is where I think people, investors, get misinformed. I've heard from financial advisors before, tell me, Ian, you got to buy international companies to be internationally diversified. I've asked these same financial advisors, hey, do you look at it based on revenue? Do you, a company like McDonald's, for example, do you look at their revenue breakdown and classify them as an international company? They're like, no. At a lot of these big financial advisories, a lot of these big advisory firms, the way they do it is they say U.S. company versus international. If you want international exposure as a client, you got to buy stocks, buy companies or mutual funds or ETFs that are based internationally, that are focused internationally. But here's the pitfall. I own this company, Chubb. Chubb is a company that is based overseas, but only 39% of the revenue is international. And so this is a key takeaway. Be careful. You got to be careful at home, because just if you buy a company that is based overseas, just as you buy a company that is based internationally, doesn't mean that it's an international company, quite frankly. This is an example where the lion's share of their revenue is coming from the United States. And I knew that going in, as I'm the kind of investor that looks through the 10K, I look at all the fine print, I knew that going in, I'm comfortable with it. But I think a lot of people out there, in the absence of this data, they get confused, they get fooled, they make the wrong decisions, they make misinformed decisions because they don't look at all of the data. And that's the purpose of this video. I'm trying to bring a new way of looking at things to this community, to YouTube, as I care about the community. I love this community. We are 30,000 dividend investors strong. I'm so blessed, so thankful to have everyone in this community. And so Basically, the conclusion today is you do not have to buy companies that are international to have that international exposure. And so I'm going to take a step back here real quick. Why am I doing this video? We are 30,000 subscribers strong now. I'm answering 30 of your questions out there. And one of the questions I've received so many times on my channel, bless you all, I love these questions, is Ian, do you own international companies? One, you download my portfolio, you'll see I own a few of them, and one of them Unilever, another one Chubb. But yes, I do, but that's not how I look at it. International company, US company, doesn't matter to me. What matters to me is, bam, revenue. Where is the revenue coming from? And I look at it holistically this way. And so you'll be able to download my new portfolio in a few days here, sometime this upcoming week. And you'll see this whole detailed analysis in there. But for now, here is the summary of it all. And again, you want to download my portfolio, sign up in the description below. I'll include a link. Everyone, I'm so thankful for your support. If you enjoyed the video today, if it provided some information to you, anything that you found valuable, the best way you can support me, thank me, is by subscribing and hitting that little notification bell. Before I leave today, I want to add a disclosure, full disclosure. I am long all the stocks mentioned today. I am long. I own J&J, Pepsi, ticker symbol PEP, McDonald's, MCD, United Tech, UTX, Clorox, ticker symbol CLX, Duke, ticker symbol DUK, Realty Income, ticker symbol O, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, 3M, ticker symbol MMM, Air Products and Chemicals, ticker symbol APD, Colgate, ticker symbol CL, Unilever, ticker symbol UL, Chevron, ticker CVX, and Chubb, ticker symbol CB. I own all of those stocks in my personal dividend stock portfolio. Also, before I leave today, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment, just my personal journey here. All right, everyone. Thank you for watching the video today. I love you all. 30,000 dividend investors strong, on our way to 100,000 next. That's the next stop. I'll see you in the next dividend investing video.